Thank you for joining this morning's webinar here at 10 a.m. Pacific time. We go live every day, twice a day, once here at 10 a.m. and a second time at 1 p.m. Pacific time. Today we're going to go over your questions. We're also going to go over a live calculation of making voluntary after-tax solo 401k contributions for a partnership, such as an LLC tax as a partnership, where you file a Schedule K-1, for instance, so Form 1065, and then you convert that over to the Roth solo 401k or the Roth IRA. That strategy is dubbed as the Mega Backdoor Roth solo 401k. So, as always, today's presentation is for educational purposes. We're not providing investment advice or tax advice. We will also do a calculation right now, but before I do that, let me share my screen with you here and go over a few items regarding making voluntary after-tax solo 401k contributions. Okay, so before we get started in doing a live contribution calculation using our solo 401k contribution calculation for a partnership, so a self-employed business tax as a partnership, let's first go over a couple items. So one, if we're talking about a partnership self-employed business, you first need to identify your self-employment income from that partnership. You're going to do that by reviewing a Form 1065 Schedule 1, and you're going to look at line 14 of that Form 1065 Schedule 1. And you want to make sure it has a code A. So line 14 with the code A, that's essentially the self-employment income line for a partnership. Once you've identified that line 14 code A on the Form 1065 Schedule 1, we then plug that figure onto our online solo 401k contribution calculator. And the calculator, which we'll go to here in a moment, will perform that calculation for you, including subtracting 1/2 of self-employment income tax from that line 14 code A of Form 1065-Schedule K-1. So we're going to go over to our calculator here in a moment, our calculator, and we're going to do a live calculation for maximizing voluntary after-tax solo 401k contributions for both years 2024 and years 2025. Some items to consider or to understand when performing the voluntary after-tax solo 401k contribution calculation are as follows. One, you cannot contribute more than the overall annual 415 limit to the voluntary after-tax solo 401k. That limit for 2014 is $69,000. It increased by $1,000 to $70,000 for tax year 2025. A second item to understand is that catch-up contributions, which are contributions allowed for those age 50 or older, which is $7,500 for 2024 and the same amount for 2025, those can never be contributed to the voluntary after-tax solo 401k. So those do not count as part of the Mega Backdoor Roth solo 401k. So in short, the maximum that can be contributed to a voluntary after-tax solo 401k on a yearly basis as part of the Mega Backdoor Roth is $69,000 for 2024 and $70,000 for 2025. If you do have enough self-employment income to make that catch-up contribution, you can apply that directly to the Roth Solo 401k or to the pre-tax Solo 401k. So that would be in addition to making that full voluntary after-tax Solo 401k contribution of $70,000 for 2025. Of course, you need to have enough net self-employment income to justify the overall contribution limit as well as the catch-up contribution. So you need to have enough line 14, code A, schedule 1 self-employment income if your business is taxed as a partnership. Okay, another item to understand is that voluntary after-tax solo 401k contributions are not impacted by contributions that you make to another 401k. When we say another 401k, we're specifically talking about a full-time employer 401k. For instance, let's say you also work for Walmart as a full-time W-2 employee, that is, and you contribute to that Walmart 401k. Whether you contribute the full limit, which is $69,000 for 2024 or $70,000 for 2025 to that Walmart 401k, or just some funds to that Walmart 401k, that's not going to impact your voluntary after-tax solo 401k contributions. Therefore, you would still qualify to make the full voluntary after-tax solo 401k contribution overall limit of $69,000 for 2024 and then $70,000 for 2025. It's important to note that those contributions, of course, to the solo 401k have to be based on your earned income from the self-employed partnership. In other words, you can't use your Walmart W-2 wages to contribute to the solo 401k and vice versa. Okay, let's do a live calculation here. First, we're going to start with tax year 2024, since you still have time to open a solo 401k plan here in 2025 to make contributions for 2024. And that's to make voluntary after-tax solo 401k contributions specifically. We'll shed more light on that later here on our presentation. So the first scenario we're going to do is for 2024. So you're going to need at least $74,246 of line 14 code A schedule K-1 self-employment income to fully maximize the $69,000 overall contribution limit to the voluntary after-tax solo 401k for 2024, which would then get converted to the Roth solo 401k or the Roth IRA. So let's pull up the calculator and we'll get that amount here. Give me a moment here while I pull up the calculator. You can search for it right here on our website, on our search box. I'm going to click on it here. Okay, here's our solo 401k contribution page. So age, you don't need to put the age in because, again, catch-up contributions are not allowed to be applied as voluntary after-tax solo 401k contributions. And today's presentation is specifically geared towards maximizing voluntary after-tax solo 401k contributions. In future webinars, we will do a presentation regarding maximizing voluntary after-tax solo 401k contributions, as well as catch-up contributions, which again would need to be applied to the pre-tax solo 401k bucket or the Roth solo 401k bucket, not to the voluntary after-tax solo 401k bucket. So we said that the income is $74,246. That's the minimum earned income from self-employment from your partnership you're going to need for 2024 to maximize the $69,000 overall contribution. We're going to select partnership. Tax year, we're going to change it to tax year 2024. Again, we'll do a 2025 calculation next. Click on calculate. Okay, let's go over this calculation here. So we plugged in $74,246 to our calculator. The calculator will subtract 1/2 of self-employment income tax, so $5,245 from that $74,246 figure. And you come up with $69,000 right there. That's the net self-employment income. Therefore, you're going to be able to contribute that full $69,000 amount there to the voluntary after-tax solo 401k, and then immediately convert it to the Roth solo 401k or the Roth IRA. So that's your maximum contribution for tax year 2024. And you have time, as I mentioned earlier, to still open a solo 401k plan in 2025 if your business is taxed as a partnership and make contributions for tax year 2024. That is voluntary after-tax solo 401k contributions as part of the Mega Backdoor Roth solo 401k strategy. Okay, let's now do a calculation for tax year 2025. So we just did a contribution for 2024. So again, for 2025, the maximum voluntary after-tax solo 401k contribution for a partnership is $70,000. So you're going to need at least $75,325 of line 14, code A, schedule K-1 self-employment income to be able to maximize the full $70,000 overall contribution as a voluntary after-tax for 2025. Let's go back to our calculator now and let's plug in that figure. So just hit enter to refresh the calculator. Okay, again, the age does not matter because you cannot contribute catch-up contributions to a solo 401k plan as part of voluntary after-tax. Those have to go to the pre-tax bucket or the Roth bucket directly for the solo 401k. So income, we're going to plug in $75,325. And business entity, we're going to select partnership. Plan year, we're going to keep it at 2025 because we're doing a calculation for tax year 2025. Click on calculate. Okay, let's go over this here. So here is the $75,325 income figure we plugged in. You subtract, or the calculator will do it for you, will subtract 1/2 of self-employment income tax, so $5,321 from that $75,325 figure, resulting in self-employment income of $70,000, so net self-employment income of $70,000. Therefore, you can contribute the full $70,000 for 2025 to the voluntary after-tax solo 401k bucket, and then immediately convert it to the Roth solo 401k or the Roth IRA. So regardless if you make more than $75,000, let's say you make $100,000 of self-employment income. So you're not going to be able to contribute more than $70,000. Let's do a calculation so you see what I'm referring to. So again, let's assume that your line 14 code A of your schedule K-1 is $100,000. Partnership for 2025 again. Okay, we plugged in $100,000. The calculator subtracts 1/2 of self-employment income tax, leaving a net self-employment income figure of $92,935. you're only going to be able to contribute $70,000 as a voluntary after-tax solo 401k contribution because, again, the overall contribution limit for the Mega Backdoor Roth is $70,000 for tax year 2025. So regardless if you pay yourself more than the calculation we mentioned earlier, let's say you pay yourself $100,000, you're not going to be able to contribute $92,000. You're still only going to be able to contribute $70,000 to the voluntary after-tax solo 401k bucket and then convert it to the Roth solo 401k. Okay, that was a calculation there. Let's go back to our main slides here. Okay. So once you make that voluntary after-tax solo 401k contribution to the designated voluntary after-tax solo 401k holding account, that is the bank account or brokerage account under the solo 401k, because remember, you need to have separate holding accounts for each contribution source and for each participant. So this designated account would be labeled voluntary after-tax. You would make the contribution into this voluntary after-tax account. So let's say the full $69,000 for 2024. So this would be your voluntary after-tax solo 401k bucket. So you make the contribution into it. Then you move it or convert it over to the Roth solo 401k bucket. So you're going to need a second solo 401k brokerage account labeled Roth, or there can be a bank account as well, labeled Roth in the name of the solo 401k plan. And then you convert that over to that Roth solo 401k bucket. Now you can convert the voluntary after-tax solo 401k contribution to a Roth IRA instead. So you would need to open you would either have to open up a Roth IRA, or if you have an existing Roth IRA, you can use that Roth IRA to convert those voluntary after-tax solo 401k funds into. Then you would need to complete our online conversion form so we collect the necessary information to report that Mega Backdoor Roth solo 401k conversion, where we issue a Form 1099-R to the government. So even though it's not taxable, it's still going to be reportable. So that's how that Mega Backdoor Roth solo 401k strategy works for a partnership or LLC tax as a partnership where you file a Schedule K-1. Now, as I mentioned earlier, you still have time to open a solo 401k for tax year 2024 here in 2025, and you can do so by your partnership tax return due date of March 17, 2025, or if you file for a partnership tax return extension, you would have until September 15 of 2025 to make those voluntary after-tax solo 401k contributions. And then you can convert them to the Roth solo 401k or the Roth IRA. So again, this is for tax year 2024. For tax year 2025, you have until next year in 2026 to also open the solo 401k and make contributions for 2025. We're talking about voluntary after-tax solo 401k contributions. And here's a page that you can take a look at further from our website that talks about the voluntary after-tax solo 401k contribution deadline for 2024 for a partnership. So take a look at that. It's got some good information there specific to still qualifying to open a solo 401k plan for tax year 2024 for a partnership so that you can make Mega Backdoor Roth solo 401k contributions. Okay. So let's take a look at some questions here. We've got a question here from David. I've determined that I'm eligible to set up a solo 401k through my Wyoming LLC entity tax as a C Corp. LLC has 3 members. Me, 98%, adult kid, 11%, adult kid, 21%. or excuse me, adult kid one. So looks like both of your adult kids own 2% in total. I'm the only one with income from this entity. So your kids are going to have to own at least 3% or more of that entity in order for you to qualify for a solo 401k plan. Because a solo 401k is for owner-only businesses. And if we're talking about non-spouses, in this case, your kids who are adult kids, they're going to need to own at least 3% or more of that LLC in order for you to be able to contribute to the solo 401k. So the solo 401k plan would be sponsored by that limited liability company. You would contribute based on your W-2 wages. Your adult kids would not contribute if they don't have any W-2 wages. So just you can contribute, provided again that your adult children own at least 3% or more of that LLC. Okay, let's take a look at another question here from David. What constitutes eligibility to participate in the solo 401k? Their membership percentage or existence of active earned income? So again, a solo 401k is for owner-only businesses. So the adult children have to be both owners, so 3% or more owners, and W-2 employees in that business in order to contribute to the solo 401k plan. If they're only owners in the business, they have to be at least 3% or more, but they don't have to contribute, but that's going to impact you because in order for you to be able to be eligible for a solo 401k, your adult children have to be 3% or more owners in that LLC, even if they don't contribute. Okay. Looks like David's got another question here. Assuming that they are eligible to participate based solely on their membership interests, will they be auto-enrolled in the plan based on auto-enrollment feature of the plan that is placed to take advantage of the $1,500 tax credit? If they will be auto-enrolled, is there anything that needs to be completed to let the plan know that they will not be contributing? So you can fill out our opt-out form so that they don't have to contribute to the plan. And again, they won't be able to contribute regardless if they don't have any W-2 wages from the business, where they have to be at least a 3% or more owner. So in short, you can opt out of contributing to the plan and you can still qualify for the auto contribution credit. And you would file Form 8881 each year to claim that $500 per year auto contribution credit for 3 consecutive years for a total of $1,500 during those 3 years. And that's a deduction taken by the business, not the individual. And it's a dollar for dollar credit, actually. Okay, another question here. I've set up my non-prototype account with my existing Fidelity platform and I'm ready to fund. I will be making Roth contribution. I have an existing Roth account from an old employer that I rolled over years ago. Does my solo 401k Roth deposit go into the non-prototype account versus my existing? I don't mind having 2 Roths with Fidelity, but just want to know my options. So number one, if you roll that former employer Roth 401k to a Roth IRA, you can't transfer that Roth IRA to the Roth solo 401k because the Roth IRA regulations don't allow for it. On the other hand, if you got that Roth 401k and it's a former employer Roth 401k, then that former employer Roth 401k can be transferred to the Roth solo 401k, and we can assist you with that by completing the applicable transfer form that you would obtain from that former employer plans administrator forward to us, and we'll fill that out for you. And that would be a non-taxable trustee-to-trustee transfer from that former employer plan Roth 401k to the Roth solo 401k. Note that transfers of Roth 401ks, former employer Roth 401ks, or any former employer Roth type, like a Roth 403b or a Roth TSP, those transfers do not count towards your annual contribution limit. So you can transfer an unlimited amount from that former employer Roth 401k or Roth 403b or Roth TSP, for instance, without impacting your annual contributions to the solo 401k, whether voluntary after tax, Roth, or pre-tax solo 401k contributions. Okay, it looks like David has another question here regarding the $1,500 auto contribution credit. Who claims that credit in this scenario, assuming that I'm the only one participating? Again, it's going to be the business, not you. The auto contribution credit is claimed by the business. So we have a walkthrough that we provide to our clients that they can share with their CPA when completing that Form 8881. And it also talks about how to report it on that business tax return. All right. Looks like we got another question here from David. Mega Backdoor Roth, can contributions into the after-tax voluntary contribution account be moved to the 401k Roth sub-account or only to an individual Roth IRA? Good question. Let me share. So the answer is they can be, the voluntary after-tax Roth solo 401k contributions can be converted over to the Roth solo 401k or to the Roth IRA. We find that most clients convert it to the Roth solo 401k, and I'm going to share with you why here in a moment. Let me pull up that screen here and I'll share that with you. Okay, so let's take a look at this page here. This is our voluntary after-tax solo 401k page on our website. So I'm going to scroll down. So here's a good chart to look at. Should I convert to a Roth IRA or a Roth solo 401k? So here's converting to a Roth IRA versus a Roth solo 401k plan. Most clients, again, like to convert to the Roth solo 401k plan because they like to keep the Roth funds within the plan. So that way they can use those funds for investing in the plan. And also they can use it for borrowing from the plan through a 401k participant loan. They also like to use it for investing in real estate where the 401k obtains a non-recourse loan. So it doesn't trigger unrelated debt finance income tax. And what is more, resulting from Secure Act 2.0, require minimum distributions no longer apply to Roth solo 401k plans, which puts it on even heels with the Roth IRA. So this is a good chart to look at. Okay, let's take a look at some more questions here. Yes, your adult children need to own at least 3% or more of that LLC in order for it to be considered an owner-only business. All right, so thank you for joining today's live webinar. We're going to have another one today at 1 p.m. Pacific time. We're going to be discussing the Mega Backdoor Roth Solo 401k for a sole proprietorship. And then next week, we're going to pick up again with going over various solo 401k contribution calculations. We'll do live calculations like we did here using our solo 401k contribution calculator, except next week, we're going to switch it up and we're going to do some calculations for those who are looking to maximize their Roth solo 401k contributions by making employee Roth solo 401k contributions, as well as employer Roth solo 401k contributions, in addition to the Roth solo 401k super catch-up contribution for 2025, which is $11,250 for those who are age 60, 61, 62, or 63. And then also the regular catch-up contribution of $7,500 for 2024 and 2025 for those who are age 50 or older. So we've got some exciting live webinars next week. We're going to concentrate again on calculating those type of contributions using our contribution calculator. So we'll look forward to see you next week. And again, we'll be back here at 1 p.m. Pacific time. Until then, have a great day. Actually, it looks like we got a couple questions here that snuck up. Let's take a look at those, and then we'll be done for this morning. Would it be wise for me to open up 2 more non-prototype accounts with my Fidelity account, even though my goal is focused on Roth only for now? Pre-tax, Roth, after-tax? Great question. So it's important to understand that the solo 401k that we provide already has the ability to make voluntary after-tax solo 401k contributions, Roth employee or employer solo 401k contributions, as well as pre-tax solo 401k contributions in addition to the mega backdoor, which means that you can either open those additional brokerage accounts now, even though you're not required to, or you can do it later. Why? Because the plan is already built to allow for all those contribution types. Let's look at one item here real quick. Let's do a search here for separate holding accounts. So here's a good page to look at on our website regarding separate holding accounts. So here's a 1 participant plan. And again, our plan is already built to allow for all these different sources. So if we're talking about a 1 participant plan where there's only 1 participant in the plan, you would have 3 separate bank accounts or brokerage accounts under the plan. So it's still considered 1 solo 401k plan, but because a solo 401k is a defined contribution plan, the law requires that you have separate sources for each separate brokerage or bank accounts for each source. So if we're talking about Fidelity, for instance, the first brokerage account would be titled pre-tax, the second one would be titled Roth, and the third brokerage account would be titled after-tax. So 1 plan that's sponsored by the self-employed business, 3 holding accounts. Here's an example of a 2 participant plan. Let's say you have an LLC taxed as a partnership and both spouses are participating in the plan. So both spouses get a Schedule K-1 and report self-employment income on that K-1 so they can make contributions to the plan based on their respective reported Schedule K-1 self-employment income. So the LLC would sponsor the solo 401k plan, so 1 plan. Here we have an additional 3 holding accounts because there was a second participant. So the result is a total of 6 brokerage accounts or bank accounts, 3 for each participant for each source of funds, pre-tax, Roth, and after-tax. So as part of the mega backdoor Roth strategy, you would make that voluntary after-tax solo 401k contribution of, let's say for 2024, of $69,000 to the voluntary after-tax solo 401k bucket. Then you would convert it to the Roth solo 401k bucket. Of course, if you have a Roth IRA, you can convert it to a Roth IRA instead, your existing Roth IRA, or you would open up a new Roth IRA. Because again, the voluntary after-tax solo 401k contribution can be converted to the Roth solo 401k or the Roth IRA. Okay, so let's see if we have any more questions here. What is the general structure to a solo 401k? Can I set it up with a company that has other employees? Well, let's go over to our eligibility page here. So a solo 401k is for owner-only businesses with no full-time W-2 employees. Let me share that with you here. Give me a moment here. Get to that page here. Okay, so here's our solo 401k eligibility page. So qualifying for a solo 401k. So it's for self-employed individuals and owner-only businesses. So what that means is, let's say you have a sole proprietorship, you might be a contractor. You as the contractor would sponsor the solo 401k, and you would be the only participant in the plan. Let's say it's a S corporation or an LLC taxed as a S corporation. You would have to be an owner in the business as well as an employee in the business. If you employ any full-time W-2 employees, so anyone working 1,000 hours or more who is not an owner in the business, but they're just a common law employee, so a W-2 employee who's not an owner, then you would not qualify for a solo 401k plan because you employ a common law full-time W-2 employee, that is an individual working 1,000 hours or more in your business. There's the spousal exception where the spouse can also participate in the solo 401k plan, and she doesn't have to be an owner in the business, but he or she would have to be working under the business. So using our LLC tax as an S corporation example, your spouse would have to be a W-2 employee, but she would not have to be an owner in the business. But you would have to be an owner in the business. Okay, so take a look at that eligibility page there. You can exclude part-time W-2 employees, those working under 1,000 hours, when opening a solo 401k plan. All right, so thank you again for joining today. We'll be back again here in a couple hours. Until then, have a great day.